So I want to talk about some complex issues too, because they're going to arise in short sales. And the first complex issue I want to bring up is regarding the deficiency. The deficiency can be defined as the difference between what the bank receives and what the homeowner owes. Okay? Most homeowners are doing short sales, and their biggest concern is, am I going to be forgiven for the deficiency? The answer isn't always yes. It is most of the time. 99% of the short sales that I see, if the bank approves them, our clients are off the hook. But that's not every case. I've done short sales where the homeowners were responsible for part of the deficiency or the balance after closing. Sometimes they bring a check to closing for a small amount. Sometimes they have to sign a promissory note at closing. Picking on Wells Fargo again, going to their website on short sale guidelines, says the same thing. It says that, look, there may be occasions where a homeowner has to pay us back something. But, we'll let you know ahead of time so you can get legal advice and decide whether to agree or not. We had one recently where the mortgage company, in the middle of the short sale process, came to my office, and said, if you want to do a short sale, we want $40,000 from your client. And we're not talking about $1 million house either, just so we're on the same page. My client's devastated. It's not $40,000, it's not $4,000. He asked what he should do. And I said, I suggest that you counter back at $1,000. I mean, that's what we've been doing as standard practice. And he said, I don't have $1,000 either. He's like, I got $100. I said, okay, counter back at $100. Counter back to the bank, they accepted $250 from $40,000. How much sense does that make to you people in here? Doesn't make any sense to me. But for every one that I've been successful on, there's a failure story too, where the bank wouldn't budge. So I let people know during our consultations that there's a possibility they may owe money, but that it's extremely rare, and if it happens, I'll fight for them. And under no circumstances are they going to be compelled to proceed on terms that they don't feel comfortable with. A lot of people confuse the deficiency with something called the Mortgage Forgiveness Debt Relief Act. A lot of people say to me, Bill, aren't my clients protected by law? The bank's not allowed to come after them. No, it's actually the complete opposite. The law does allow the bank to come after them. The Mortgage Forgiveness Debt Relief Act involves the IRS and income taxes that are derived when the debt is canceled and forgiven. We'll talk more about the Mortgage Forgiveness Debt Relief Act, but for purposes of complex issue number one, it doesn't have anything to do with the deficiency. There is no law in New Jersey or Pennsylvania that says they can't collect it. It's the opposite.
But the Mortgage Deficiency Act is no longer
The Mortgage Forgiveness Debt Relief Act is no longer valid.
Okay.
That's correct. And we'll go over that because complex issue number 3 is taxation. Complex issue number 2 is bankruptcy. And again, I don't want you guys giving these, again, this I would consider this legal advice, right? So you don't want to take my presentation and read it to your clients. This is stuff I'll go over with them. I just want you guys to know this for your own knowledge. I think it will enhance the process of working on short sales. Bankruptcy. We don't handle bankruptcy, so that's step number 1. But bankruptcies and short sales are very common together. There are 2 types of bankruptcies that we see. There's more than 2, but the 2 that we see the most are Chapter 7 and Chapter 13. In their most basic forms, Chapter 7 is the one where the debt goes away. Chapter 13 is the repayment plan. Okay? Chapter 7s and short sales play very nicely together. I think most Chapter 7s are done in a few months, and during that process, the house gets abandoned by the bankruptcy trustee, and once the property has been abandoned by the bankruptcy trustee, we're free to sell it. We're free to close, free to do a short sale, free to do anything. And not only that, the short sale becomes without consequence to our homeowner, right? Because if they're protected by a Chapter 7 bankruptcy, the bank's not allowed to ask for money, which is rare anyway, but they're still not allowed. Tax issue, which we're going to talk about, is killed by the bankruptcy. And there shouldn't be any excess credit damage over and above the bankruptcy on the short sale. So the short sale becomes without consequence for a Chapter 7 client. I like working with Chapter 7 clients. Chapter 13s are a little different. And the reason they're different is because 2 motions generally need to be filed in order to do our short sale. The first is a motion to sell, right? You need the court permission just to sell the house altogether, right? But the second motion, which I'm going to paraphrase, I don't know the exact term for it, is a motion to retain professionals or for professional retention. It's a way for, we have to petition the court to get paid, in other words. We need a motion filed to allow the sale and a motion filed so the realtors and the attorneys can be paid. Well, guess who files those motions? Their bankruptcy attorney. He's not free like me, right? I'm not charging them for the short sale can almost guarantee their bankruptcy attorney is charging them for the bankruptcy. He's not going to do the motions for free. They're going to run about $1,000, give or take. So we have to be careful when we're doing short sales for Chapter 13 clients. We want to be careful not to bill it as a zero cost option to them, because technically it's not. Technically they're going to have to pay their attorney to file those motions. All things I go over during my free consultations with these homeowners before the short sale.
With a Chapter 7, am I wrong that the lien still follows the property?
That's a good point. So you can't file Chapter 7 and then sell your house and pocket the money, right? I mean, you can file Chapter 7 and avoid paying the bank ever again, but you can't sell it and pocket the money. And the reason for that is you're correct. The lien stays on the property. So you have to think of it this way. When you take out a mortgage, you sign two very important documents. You sign a mortgage and you sign a note, okay? When you file Chapter 7 bankruptcy, you might as well, you can take the note and light it on fire, right? Because you have no liability to pay under that note anymore. But that mortgage stays against that house. The mortgage is a lien document. It stays against that property. So if you're going to sell it, you've got to either pay that mortgage off or short sale it, which is why I do short sales for people with Chapter 7s. And to make things even crazier, and why title is so important again. A lot of our bankruptcy clients will file bankruptcy. They have lots of problems, right? They have judgments for not paying credit cards and doctor's bills and things like that. They think that the bankruptcy just takes care of it because they don't have to pay it, but they're wrong. The lien stays against the house. So if I have somebody who did a Chapter 7 and has a mortgage and 3 judgments, I got to get those judgments paid somehow, right? I got to go to the bank and ask them for money. They are part of the short sale. Even though the seller has no liability to pay them ever, the lien generally stays against the house. Of course, the homeowner, if they paid extra, could pay their bankruptcy attorney to have them removed judicially, but no one does that, right? Chapter 7s are usually in and out, right? I don't have to pay, good, I'm done. They don't want to pay the extra money to have the liens removed because it doesn't matter to them. Maybe they should. Taxation. The most complex issue, I think, involving short sales, and one of the most important. When a short sale is successful, I mentioned earlier, they're going to forgive the debt. It's just those rare cases where the bank requires a contribution or some kind of payment. Most successful approved short sales, the seller is let off the hook for the deficiency or the balance. The IRS considers that to be income. Forgiven debt is considered income. If you have an American Express card and you owe $30,000 and you settle it for $15,000, you just received $15,000 in income. You're going to get 1099. Just like you get 1099 for your commissions. It's a 1099-C though in this case for the cancellation of debt income. You're required to pay tax on that money unless you qualify for an exemption. Just like most tax rules are exemptions. One important factor I want you to know about forgiven debt taxation is that it doesn't just apply to short sales. This is something that will help you in your practice. I don't want you to be on a listing appointment and you tell the homeowner it's going to be a short sale and they say, I'm not doing a short sale. I heard about this tax penalty. I'm not paying this tax. I'm not doing this tax. I'm paying this tax on the short sales. And you might walk out the door and say, okay, sorry, I can't help you. But what these people need to know is it's also going to apply to foreclosure too. If it goes through a foreclosure and goes through a sheriff's sale, the bank doesn't come after you, which generally won't anyway. Guess what? You're getting a 1099. So the foreclosure is not a way out either. The way these people get out is by the exemptions. So if you run into a listing like that, say, you better talk to the attorney my office works with, or any attorney, or any CPA, because this may also apply to foreclosure as well. I think it's important that they understand that, and also for you so you don't lose the listing. The exemptions. There have historically been 3 exemptions to paying tax on canceled debt when it comes to real estate, short sales, foreclosures, and deed in lieu of foreclosure, because technically all 3 would involve canceled debt income. The first exemption, we're going to get out of the way, is bankruptcy. Right? I mentioned that earlier, that's why I'm doing it first. If your debt is canceled in a bankruptcy, it is not taxable. Remember I said I love Chapter 7 clients? I don't even have to explain this to them because the tax doesn't apply. Their debt was canceled in the bankruptcy, they're not responsible for paying the tax. I just tell them the IRS form number so they can bring it to their accountant and they're good. The second exemption was brought up and discussed, the Mortgage Forgiveness Debt Relief Act. This has been around since roughly 2007 or 2008, and it was a great exemption. It exempted a principal residence sale. So if you did a short sale and the home was your principal residence, you didn't have to pay tax on the canceled debt. The only other requirement is that the money that's being canceled had to have been used for the real estate, right? Like, if you took a home equity line out and bought a car with it, and then did the short sale, that's not covered under the Mortgage Forgiveness Debt Relief Act. The shorted money had to be used for the house and had to be your principal residence. It's a great exemption. It covered 98% of our clients in the last several years. 2017 was the first year that law wasn't in effect. It expired and was not extended. So now it no longer exists. So how are our clients going to avoid this hefty IRS bill at the end of the year? There's another exemption, and it doesn't just apply to real estate either. It's called insolvency. It's the last word of the bottom sentence, in case you need to spell it. Insolvency. Insolvency helps people avoid paying tax on canceled debt, no matter what the source of the debt. Remember the American Express example I gave? Well, the Mortgage Forgiveness Debt Relief Act's not going to help you with that, right? It's a credit card. Insolvency. The way the rule reads, to the extent you are insolvent, you can avoid paying tax on canceled debt. So it's importantly worded that way, and I'll explain why. To the extent you're insolvent, you can avoid paying tax on canceled debt. Here's how it works. You do a successful short sale, the bank forgives the debt. Let's make up a number. Let's say we have a mutual client who does a short sale with Bank of America, and he owes $100,000. When the short sale is done, Bank of America accepts $80,000. Okay? There's a $20,000 difference. Bank of America agrees in writing to cancel and forgive it. Following year, around January, February, our client's getting a 1099-C. There's going to be a number on that 1099-C. What's that number going to be? $20,000, exactly. So he needs to sit down with his accountant at April of the following year and determine whether he qualifies for insolvency. So how do you figure that out? Well, what is insolvency? Somebody who has a negative net worth. Somebody who has more debts than assets. You are considered insolvent if the total of all the debt in your life is higher than the total of all the assets in your life. Right? Has anyone in here ever tried to calculate their net worth? I mean, usually you'll do it for a life insurance application. The only people who care about their net worth are the wealthy. Right? Like Donald Trump, it's worth $20 billion. Oprah, it's worth $100 billion, whatever the case is, whatever the actual numbers are. Because it's a status symbol for them. But no one else cares what their, unless you're that rich, no one cares what their net worth is. I care, because I want it to be negative for our clients. Right? We want the number to be negative. And it's negative when your debts are higher than your assets. So you're sitting with your accountant, and you have a 1099 for 20 grand. Your accountant's going to give you an insolvency worksheet. And it's going to have a list of what the IRS considers assets, a list of what the IRS considers debts. And you're going to fill it out. Now, if you fill it out and your assets are higher, forget it. You're going to pay the IRS. And no one's going to feel bad for those people either, right? I mean, if their assets are higher than their debts, how did I get their short sale approved in the first place? Right? I mean, if your assets are higher than your debts, you should have pulled from those assets and paid the bank instead of shorting them. So in those circumstances, if I was able to save you from paying the bank, and you owe a fraction of it in taxes, still a great success. But most people aren't going to be in that boat. Most people are going to be insolvent. Once the numbers are filled out on that insolvency worksheet, your accountant is going to compare the totals. Assets versus debts. For this particular client, because the 1099 said $20,000, all that needs to be shown is that the debts are $20,000 higher than the assets. And you're including the house, by the way, and the debt. Because the timing of this is as of the time of the sale, not as of the time of the return. So you're including the house, you're including the mortgage. All you have to show is that the difference between the debts and assets is equal to what the bank forgives. So in this case, we need his debt to be $20,000 higher than his assets. What happens if it's not? And if that's the case, it's 100% exemption. What happens if it's not? Let's say he's still insolvent, but his debts are only $15,000 higher. Well, what happens there?
He owes 5.
He pays tax on 5. If he doesn't owe 5, he pays tax on 5, which is substantially less than paying tax on 20, and substantially better than paying the bank the money. Okay? Now, think about it. The clients who would have qualified for the Mortgage Forgiveness Debt Relief Act, that great rule that exempted all those principal residents, how many of them do you think were insolvent too? 100%? Pretty close to it. Who is going to do a short sale on their primary home, the home that they live in, the home they want to stay in, if they have money? Why wouldn't they just keep paying their mortgage and stay? Most people who would have qualified for the Mortgage Forgiveness Debt Relief Act will also qualify for insolvency. Out of the thousands of clients I've represented, I can count on my hands how many were not insolvent. And the ones who weren't insolvent knew they weren't insolvent. They knew they were going to be responsible for the tax because they have good relationships with their accountants, and they were okay with it.
This only goes for the tax year that the sale was done.
So we're talking about the year in which the sale was done. So if we're closing on a short sale today, you're getting a 1099 in January of 19, and your taxes are due in April of 19. So you're filing in April of 19, but your assets and debts are going back to today. And if you think about it, think about the house by itself, right? The house by itself is putting most people on the red. That example client we went over, if he owes 100 and we sell it for 80, he's already 20,000 in the hole, right? His net worth is negative 20,000 without even looking at his other assets and debts. And most people have other debts: student loans, credit cards, car loans. How many of our clients doing short sales own other real estate with equity? How many of our clients doing short sales have substantial amounts in their checking or savings accounts? Not many. And those are the ones who don't qualify for insolvency. So, summary of everything we kind of went over. Short sales are here to stay, and there are clearly plenty of listings to go after. A lot of people shy away from short sales. I know a lot of agents who don't want to do them. And maybe they're right. I mean, they're complex and they're overwhelming, and they can contain multiple legal issues and multiple impediments to getting to closing. But I think if you follow my tips, and I think that you understand the misconceptions, and you surround yourself with people who know how to do them, the right attorney, the right title company, you can get short sales done, you can save people from foreclosure, and you can make a lot of commissions in the process. Any questions?
Is there a percentage of the legal costs on, for each transaction, for what the seller might look forward to?
I'm sorry, can I repeat that?
If someone is applying, to your office
Yeah.
for assistance, and you go through it, is there some way that they can anticipate how much your fee is going to be
There is no fee.
for the whole thing?
None. I do not charge the seller. So most mortgage companies, New Jersey is considered an attorney state. And in attorney states, the mortgage companies will pay reasonable attorney fees for my services. So we put that on the settlement statement and get paid at closing. So there's no fee from the seller due, or from the buyer, or from the realtors. No fee. Sounds crazy, right? It works.
Sounds great.
It works. It works. I mean, it allows a homeowner to get somebody who does a lot of work in this field for no charge. I mean, try getting a top divorce attorney for free. Good luck.
That would be a major consideration.
Yeah, and I think that's one of the reasons why we've been successful in helping homeowners is because of that fee structure, because there is no charge to them.
Is your initial consultation, you can do it by phone?
Oh, that's a great question. Most of them are actually done by phone. So I practice all over both New Jersey and Pennsylvania. As far as west, I guess Pittsburgh would be as far in Pennsylvania, and Jersey from Cape May to Hoboken. With clients in every county, in every city, every town. Most of the calls are done by the phone, which works for me too, because I can take notes when I talk to the people. So they're almost all done by phone. They range from, depending on, a Chapter 7 client will take 10 minutes. One who's been through a 7 already, because I don't have to explain the consequences in that great of detail. Whereas somebody who's still current on their mortgage and they're teetering between doing a short sale and staying, that call's going to take an hour and 10 minutes.
Right.
And they're free, and they're all, like I said, done from the phone.
When they have approved short sale in Paragon, might it refer to the fact that the bank how is the decision made that a short sale is going to be done? In other words, the bank notifies the client, or how does it begin? The initial decision, this is going to be a short sale, we're willing to see what the property's appraising at, and we'll take a number around there.
We don't want to confuse with the decision on whether it is a short sale with the decision of whether it's approved as a short sale, because the decision of approval lies with the mortgage company or a servicing agent, whoever's handling the bank and the loan. And that will require an appraisal and a financial review.
That's the numerical.
It's you who's making that initial determination. And at the listing appointment, because you're saying to these people, look, we're sorry, but your home isn't worth what you owe, and unless you have money to bring to the closing table, this could be a potential short sale situation.
Okay.
Remember the two ingredients, right? underwater or negative equity, homeowner without the cash to cover it. You know, I know people who have negative equity, but they brought $70,000 to closing. You know, regular clients that I've represented. You know, they weren't happy about it, but they brought the money to the table. They're not going to do a short sale. They had the money.
Right,
But if they didn't have that money, they would have been short sale clients.
okay, all right.
So at that point, you refer them to you.
Yeah, I mean, even if they don't sign the listing agreement, look, you don't want to force people into doing anything. If they have questions and legal questions, say, listen, you know, no pressure, leave it with them, tell them to call me. Or email me to call them, and we'll schedule a consultation. It's free, they have nothing to lose. And 9 times out of 10, the short sale is going to be their best option. And if it's not, I'm going to tell them it's not. If I talk to somebody who says, Bill, you know, my house is underwater, I owe $300,000 in credit card debt, I wake up every day, I'm about to get divorced, we hate each other, we're barely scraping by. Short sale is still a good option for them, but not right away. They should file bankruptcy first. They should do it for 2 reasons. 1, because it's going to improve their quality of life immediately. And 2, because it's probably going to make the short sale easier down the road anyway. So we're not going to lose them as clients. We're doing what's best for them, and they'll come back to us after the bankruptcy's over. I may have somebody who calls me and says, Bill, I want to do a short sale. So my only issue is this house, and I need to get out of it. And then they tell me they have no money to move, and they're going to be living on the streets. But how can I tell that person to sell their house? You know, that person's probably better off staying until the bank forecloses and facing if there's any liability for it, because they can't leave. If you're going to be homeless, don't sell your house. But those are few and far between. Almost everybody I'm speaking with is a good candidate for a short sale, and it's something they want to try. And again, it's a free option. If I were billing these people hourly, they could come back to me and say, Bill, you're insane. But it's free, so it's almost always worth a shot.
Well,
And yeah, and even if they don't sign the listing, most of the time they're going to be calling you for it afterwards, because you know, my advice is going to be for the short sale. Unless, of course, they fall into that rare category where I think something else is better.
You haven't mentioned hardship.
Sure.
I thought that was, other than being underwater, that would be one of the other most important parts.
So there's 2 ingredients for a client to be a potential short sale, and then I think there's 2 ingredients for the short sale to be approved. So I mentioned earlier the 2 ingredients for the property to be a short sale situation were underwater, right, and a client without the funds to bring the closing. The 2 ingredients to get a short sale approved by the bank are a good seller and a good buyer. And this is an excellent question because it's not in my presentation, and it should be. In order to get a short sale approved, you need a good seller and a good buyer. What do I mean by a good seller? You need a seller who's got a valid hardship, right? There's many different types of hardships out there. Decrease in income, divorce, death, excessive use of credit. These are all hardships, but some are considered stronger than others. The big 3 to me are death, divorce, and job loss, or substantial income loss. Those 3, or those 4, I don't think I'm going to have a bank or a short sale mortgage company or a servicer come back to me and say, Bill, your hardship is BS, right? Who's going to say that the death of my client, there's nobody living to pay it? You know, those are good hardships, but you're not always going to see them. You're going to see clients who say their hardship is the house is too small, or the neighborhood's deteriorated, or that the property's underwater is the hardship. Those aren't really hardships, and they're weak. And what I'll typically tell people during those consultations is that their hardship is weak. I'll say, look, you guys don't have a strong hardship here. I can't tell you whether your short sale is going to be approved or not, right? I don't work for Bank of America or Wells Fargo or Citi or JP Morgan Chase. I can't tell you for certain whether your short sale is going to be approved or not. But I will tell you if I think your hardship is weak, which could hurt your chances. And I let people know, people who are current or people who don't really have a strong hardship, that their chances of success are going to be lower than somebody who does. And the other ingredient to that was a good buyer, and that should be evident in the consumption paying for the house.
One question that comes up with the conversation with sellers is a deed in lieu.
Sure.
Can you kind of explain that?
So a deed in lieu of foreclosure, what you're doing is, instead of forcing the mortgage company to go through the timely and costly foreclosure process, you're giving them the deed to the house back. You're giving the bank the deed to the house, so they don't need to go through the foreclosure anymore. And in exchange for that deed, they're supposed to agree to cancel the remaining debt on that loan. It can be a good option. I'm not sure it's a great first option in all cases, if for no other reason that I charge for them. You know, if someone calls me for a deed in lieu of foreclosure and they haven't tried a short sale, I may say, try the short sale first. You get my services for free. If it doesn't work out, we can do the deed in lieu. It's going to cost you $2,000 though. You know, a lot of homeowners faced with that would rather try the free option, especially since the result is essentially the same. You're getting removed from title, settling the debt without liability. So most people will try the short sale instead. But I still do quite a few deed in lieu. I mean, there are situations where no matter how many times we've tried the short sale, my office, my realtor, and my client, we can't get the bank to see eye on the price. And the realtor gives up and says, Bill, see if they want to do a deed in lieu. And in those circumstances, I'll actively solicit it. I will go to the homeowner and ask if they want to hire us for it. And if they can't afford it, then I may offer some type of assistance to help anyway. But that's what the deed in lieu entails. And a lot of people think that the credit damage for the short sale is better than it is for the deed in lieu. I can't confirm or deny, but I'm not going to argue either way.
Deed in lieu will still appear on the credit
Oh, sure, absolutely.
as
You know, I've seen it both ways. I've seen mortgage companies say that it goes on the credit as settled for less than full balance, which is the same code reporting for a short sale. But I've seen other banks who have actually said in their approval letter that it shows up as a deed in lieu of foreclosure on a defaulted note, which sounds pretty scary. Sounds a lot scarier than settled for less than full balance.
definitely either way, it's going to affect their
Oh,
credit.
sure. There's no doubt about it. And look, it's no guarantee. It's just like the short sale. You got to have a hardship. You got to apply for it. It's got to be approved. No guarantees. No guarantees in this business.
Will the deed in lieu also qualify for a tax document?
So that you will get taxed, you will get a 1099 from doing a deed in lieu. Remember, because the goal is forgiven debt, right? You're giving the deed over in exchange for the debt being canceled, and when the debt gets canceled, it becomes taxable. Then you have to use insolvency to hopefully avoid paying that. The story about a deed in lieu, I had a deed in lieu that I worked on. A short sale I was working on one time, and it was approved, and the buyer had walked, and the realtors, everyone gave up and they wanted to do a deed in lieu instead, and I was fine with that. And the bank, when they approved the short sale approval letter, like most, canceled the debt. Say, congratulations, your short sale's approved. We don't owe us any money when this is over. So I get the deed in lieu approved too. Guess what that letter says? You owe us the entire balance afterwards.